Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. Clearly, the news over the weekend, OPEC cutting back, other countries as well. We see the pressure in terms of commodities. We see the pressure in terms of oil. What that means, bigger picture for the Fed. This morning, comments out from St. Louis Fed President Bullard talking about the implications potentially of what higher energy prices mean for the Fed in general. I think when it comes to energy, the Fed likes to look at inflation expectations. We are seeing inflation expectations rise overnight into today. But with regard to our segment this morning, the buckets that we want to talk about, first, the crisis. Look, March was a very, very difficult month, to say the least. I've been doing this for a very, very long time. I traded markets and banks through the global financial crisis. We have said all along that there are similarities in terms of what happened back in that period and where we are now, but we think this is a different pocket of time. When you look at the testimony last week, certainly there are fingers to be pointed and blame to go around in terms of where we got to with regard to this pocket of time. But let's make no mistake about it. The Fed's tightening cycle over the course of the last year, almost 500 basis points of tightening within a very short period of time, revealed some very, very strong weaknesses in the global economy. It started with the UK. We saw what happened in the pension system there with regard to mark-to-market. We have certainly written about this, and we have certainly written about it with implications for the United States as well. Did we know exactly where it would rear its head? The answer is no. But did we think things would break and things would rear its head with regard to the Fed tightening cycle to this point? The answer is absolutely yes. And we're going through that process right now. It is too early to determine whether or not what we've seen over the course of March is completely done, which turns me to point number two, the rate structure. What is the rate market saying? We had a very strong call in the course of this whole Fed tightening cycle, even going back to 2021 with regard to where the Fed would potentially go with this funds rate. We point back to 2008. Ironically, we got to a funds rate in and around to where the Fed is pointing to right now, somewhere in the range of 5 to 5.25. With regard to the rate cycle now, we had a great call, 5% two-year notes. Unfortunately, we didn't catch the move the other way because it happened very, very quickly. And that's the state of affairs in this market. That's how these markets trade now. They're very, very quick to move, very, very quick to reprice. Now we have a two-year note in and around 4%. We have a peak terminal rate close to 5%. The Fed is certainly signaling here that they want to get above 5%. So it puts the May meeting in play here without a question in terms of how the data unfolds, in terms of how they view the recent events, in terms of the regional banking crisis and credit contraction, which we may not have enough information by the time that May meeting comes to fruition. Bottom line is the pricing right now is starting to skew a little bit more toward 25 for that May meeting. We're going to get more data this week, certainly the employment number on Friday. And then lastly, markets. We look at the S&P 3,800 to 4,200. We've been in a range for a long, long time. If you look at some stocks, though, out there clearly have already broken out with the notion that liquidity is coming back to this market. It's coming back to the market in terms of the Fed. Now, practically, if you look at the Fed's balance sheet, in the course of March, the Fed has increased bank reserves by close to $400 billion within a month. Now, the Fed is not going to indicate that that's quantitative easing because in Chair Powell's words, the intent of what they're doing now in terms of expanding the balance sheet is different than what they did in 2020. Having said that, if you look at the correlation between increasing the Fed's balance sheet and markets in general, it's very, very strong. Correlation, causation, the Fed will talk about this. But the bottom line is that Fed balance sheet is heading back up bank reserves are increasing and markets have been going up. Now, it's going to be very important to pay attention to how these dynamics unfold, I think, in the next coming weeks, in the next coming months, in terms of how the Fed handles this. We think the Fed should pause here. We certainly are not going to make a call in terms of rate decreases at this point, but at a minimal, we think stability is very important here. The Fed is trying to separate financial stability from monetary policy, and we think ultimately that's going to be a mistake. On the ground this week, we have a lot of important data. We have the ISM numbers. We have another JOLTS report. And on Friday, we'll join Fox Business, Maria Bartiromo, for a full 3 hours, 6 a.m. to 9 a.m., to discuss these topics and more. It's going to be a consequential week in terms of what this employment data signals on Friday with regard to how the May meeting pans out. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.